For those that don't know me, my name is Fuad Diri. I'm a director of the Australian Lebanese Chamber of Commerce. On behalf of the Australian Lebanese Chamber of Commerce, its President, Joe Qatar AM, I welcome everyone here this morning. A special welcome to His Excellency Consul General Charbel Macaron, to all our distinguished guests, friends and family of the Australian Lebanese Chamber of Commerce, to our special speaker, Alan Oster, and our 34th year of the Chamber, and we wouldn't be where we are today without all our sponsors. And today I'd like to acknowledge our event sponsor, which is LBN Co. This is the first year LBN Co has come on board with us, and we look forward to many more years to come. The Chamber can't ignore our sponsors, our partnership sponsors, Arab Bank, who have been there through thick and thin with the Chamber, and not to forget our platinum, silver and diamond sponsors who have always been supportive of the Chamber and have supported us for many, many years. So, as you know, the Chamber, this is our 15th year now of our annual breakfast, and as you can see, the breakfast supported throughout our community and throughout the Chamber, and we've got a big turnout today. So, without wasting too much time, I'm going to allow us all to start our breakfast, and then shortly afterwards I'll introduce Alan Oster, who's the Chief Economist of the National Australia Bank, and he's got a few words to say to us. So please enjoy breakfast now, and I'll be back shortly. Thank you. Today, you know, we're very lucky to have the NAB's Group Chief Economist, Alan Oster, and I suppose with everything that's going on out there in the market and what's happening with things within the property market where the economy is going, having Alan here today is, I'm sure, quite beneficial. That a lot of people want to hear what Alan has to say and what the view of the NAB is and where we're heading into the future as well. So, Alan Oster is the National Australia Bank's Group Chief Economist. Alan joined the bank in 1992 from the Federal Treasury, where he worked for 15 years. His special field being economic forecasting and monetary policy. Alan grew up in Newcastle and graduated with first-class honours in economics from Newcastle University. He also holds a master's degree in economics from the Australian National University. Immediately before joining the bank, Alan was a senior advisor in Treasury responsible for economic forecasting and modelling. In 1987, Alan was secondary for nearly 4 years as Counsellor, Economic and Financial within Australia's delegation to the Organisation for Economic Cooperation and Development in Paris. As Group Chief Economist, Alan is responsible for NAB's global economic and financial forecast. He is also a highly respected and much quoted commentator on Australian and global economic trends and policy issues. Alan, the stage is all yours. I'm sure all these people are anxious to hear what you've got to say.
Thank you. It's a pleasure to be here to address you in terms of what we think is going to happen. And the Chamber's got a copy of these slides, and so if you want a copy, I'm more than happy for you to go through them. And what I'm going to do is talk a little bit about where we're seeing the world, where we're seeing Australia, and particularly I'm sure people will be interested in what we think is happening in the property market. So I'll talk a little bit about that and obviously rates. The first slide I'm going to put up, it's got a lot of words on it, but I figured that this is a summary of what I'm going to say. So if you spend a couple of minutes and I'll talk you through what it means. Basically for us, we think global growth's slowing. Particularly you see it slowing in Europe, you see it slowing in the UK and Japan. So previously, for the last couple of years, everything's been going up. Now, a lot of things are coming down. A lot of it seems to be in the trade area. So if you look at the exports, global exports are down a lot. We're not sure why. It could be Trump and trade wars, etc., but it's more broadly based than that. the two economies that matter, and I'm sorry if there's any POMs here, hopefully there's not too many, Brexit doesn't, all right? They're about 2% of the world, and if it means their economy grows 1% slower, doesn't matter. The two that do matter for us is the US and China. And the US, it is slowing, but I think what's happening is policy is not going to basically be tightened much more. So there's been a change in the policy. And China, I think it's okay. And I can talk about China in more detail because there's a lot of people out there saying China's a bubble, it's about to blow up. It's not. If I'm talking about Australia, domestic growth last year, particularly the first half, was quite strong. However, it has weakened a lot in the last half of last year. You would have seen that in the national accounts. And from our data, it's continuing to weaken in through to February. So our latest data is February. I should say one of the differences working as the chief economist now for NAB, rather than running the forecasting modelling area of the Treasury, is we have huge amounts of data. And I was saying to someone else earlier, any electronic transaction that's done, I can track it. And there's 5 million transactions a day. So we watch it really carefully. The critical area for concern is the consumer, for me. And especially what's happening is you're not getting a lot of wage increases. You do have to pay your high utility bills. People are not happy about their house prices, and they're also not happy about the amount of debt they've got, so they're into paying off debt. And anything that's discretionary, they don't do. And that is continuing, and we don't see that disappearing anytime soon. However, don't be too negative. There are things such as infrastructure, and I'll show you later, but basically, if you just add up the transport sector in Melbourne and in Sydney, it's $25 billion a year. Now, to put that in context, the mining boom was $120 billion. So you've got about a quarter of the mining boom going through the infrastructure. Very strong growth also in public consumption. That's a technical thing, national disabilities. Previously, you didn't actually be paid by the government if you were looking after someone in your family. Now, if you're going it through NDIS, you are. And so you get very strong growth in consumption. And there's another one, LNG. We've been building a hell of a lot of LNG platforms. We're now all finished. And so they might not be making any money, they're not employing anyone, but it counts for GDP. So you put it all together and you get a big slowing in the private sector, but you've got these offsets in the public sector going on. We are much weaker than the Reserve Bank. The Reserve Bank basically is expecting growth of around 3. We think it's going to be closer to 2. And the reason for that is you're getting about 0.75% of growth out of essentially the things I've just talked about with public sector, etc. But the private sector is not doing that well, and we see it continuing. And once you get beyond 12 to 18 months' time, the level of spending in that public sector is going to stay at the same level, which means it doesn't add to GDP. So you go down to something more like 2%. And then inflation's not a problem, wages are not picking up, and you would have already seen both sides of politics talking about wages and what they can do for taxes and all that sort of stuff. And the labour market is good at this stage. The big issue on the labour market is it a better indicator of what's really happening because employment's still strong? Or is it just a lagged reaction to the strength that we had in the middle of last year? And we think it's a lagged reaction. So for us, I'll talk about this a little bit more. We think we're in a situation where sometime in the next 6 months, the RBA will probably, and presumably after the election, the RBA will probably say, well, why shouldn't we basically try to stimulate this economy a bit better? But it's still a good economy. It's just that if you're in the private sector, there are some sectors that are problems. Okay, so that's sort of where I'm at in the big picture. So it's an okay world unless you happen to be in discretionary retail and the construction cycle. Okay, so globally. Sorry guys, you're obviously in it. So this is sort of a one shot. What we try to do is we try and say, okay, where are you now? because as we used to say in the Treasury, you get your forecast a lot better if you know where you're starting from. So all we're trying to do here is get a leading indicator of where the world is, and we get about a 6 months lead. And what is it? It's basically global shipping, global air freight, and a few other things. And basically you can see it's slowing. And we think that is going to continue. Now, I'll put up the next slide, which has got a lot of data on it. But basically what you see is over here in manufacturing, that line there is essentially a zero line. And you see essentially, particularly in Europe, you see it also in Japan, etc. The US is still okay, but essentially global manufacturing has slowed a lot. US is probably the only exception. Where you get the big changes in global growth, I talked about, there's the various contributions. The black line there is exports, and you can see the growth this year has significantly slowed because of the export story. The services sector on the other side has slowed a little bit, but they're still pretty strong. So that's sort of what's happening in the global economy. If I talk a little bit about the US, we can look at a lot of things in the US. They have tightened policy a lot. I'm going to put up a chart now. Let's see if I can get it up. A lot of spaghetti here. But basically what I'm looking at is, and the one that's got most of the spaghetti is actual GDP. And then I've got some models that I just basically forget about and just run them and try and say, okay, let's just see, based on what's happened in the past, how good am I at explaining what's going to happen? And all I'm trying to show here is I've got all these models want growth to come down. And they want it to come down to something like 2% this year and maybe 1.75% next year. And what's important in these models, interest rates is really important, high currency is really important. So you've increased a lot in terms of policy tightness, and that takes time to feed through. So everybody expects the US to continue to slow, except maybe Trump. It will slow. There was a big debate in the financial markets about whether 2020 was going to be a recession year. We don't believe that, but we do see a big slowing. And what's happened, of course, people have the same sort of models as we do. Interest rates, red is what they've actually done, black is what the market's now expecting. So if you put it in context, in December, when they did their last rate rise, they took essentially their cash rate to 2.25%, and they said, okay guys, by the end of next year it's going to be 3.25%. Now they're saying it's not doing anything. That's what the market's saying. Why? Because they're worried that the economy naturally will slow. We're not expecting that Trump's going to produce another big fiscal package. We do think that the Americans are in desperate need for a trade deal. I think the Chinese want it as well. And at this stage, it looks like a deal's going to get put together. So at this stage, we're sort of saying, we're assuming that sometime soon, they're going to get a deal. If I move then on to, to China. Very boring graph on the left-hand side, but a really important one. Red is services. Services is now 55% of the Chinese economy. Think health, education, tourism. And it's growing at 8%. Black is basically secondary industries. So think industrial production and all that sort of stuff. And that has slowed a lot. And a lot of the partials out there are all about the idea that, you know, you've built too many apartments and steel's not as strong, etc., etc. They're missing the point. The point is that 55% of their economy is still growing at 8%. And that's what they want. They want that. And when you look at the flow of money into Australia, they're basically investing in those same areas. And so that's really important. So we have growth in China this year is 6.25-ish, and about 6 next year. And that is important because China, as the way economists look at it, is the biggest economy in the world. And there's a lot of catch-up still to go. So If China grows at 6% or thereabouts, it actually generates more new GDP to the world economy than it did when it was smaller and growing at 10. So that matters. The other thing I've put in here on the right-hand side is essentially a measure of wealth. US, or if you look at GDP per capita and make 100 as the US level, Australia's up around 90. All this graph is trying to show you is when countries industrialise, it goes up a lot. So unless you shoot yourself in the foot, China will continue to grow strongly. Now, you always worry a little bit about what debt they've got and where they've got it. And the big issue is the state-owned enterprises, most of whom are losing money, are 20% of the economy and they own 50% of the debt. So the question then becomes, when does China run out of money to keep funding these things? And the answer is no time soon. So for us, we would like to see more reform in the structural part of the economy. We'd like to see less debt. But I think if any country can manage this, China is probably it. So I don't sort of get uptight about the stories I hear all the time about China being a bubble. I just don't think it is. All right. I'll just flip this. We've basically got global GDP at around 3.25, maybe 3.5 next year. It's sort of long-run average. You would have heard a lot of, I've told you a lot about the sort of economies that are coming down. What I haven't mentioned is Latin America that's sort of coming out of recession, and I haven't talked about India that's still growing at 7%. So there's this mix going on. I think there's probably downside risks, but it's not catastrophic. One last thing I should have said on China. People worry that if China falls over, Australia will be in deep trouble. I think the real way you should look at it is if China and America somehow manufacture the world economy to fall over, we're in deep trouble. All right? But if China is basically just the world's okay and China's just trying to keep their growth going, what do they need? They need the stuff that we dig out of the ground. So Australia's even well positioned unless you run into a global recession. Okay. The currency, just very quickly, red lines there is basically a statistical measure of confidence about our model. First thing I'd say to you is the red line's plus or minus 5 cents. So I have a lot of currency specialists who sort of tell you what's going to happen next week. When I go to see the board, I say it's plus or minus 5 cents, all right? And the model suddenly wants about 72 against the US plus or minus 5. We think basically the Australian economy, the currency might pick up a little bit to the mid-70s, but it's basically where it should be. All right, so now I'm going to talk a little bit about the Australian economy. Every month we go out and we ask 1,400 firms a series of structured questions, and we've been asking it since the late 80s. And two sort of questions that we ask is confidence, and the press always talks about confidence. We also ask about how did you actually go? What is your sales? What is your forward orders? What's your profits? What's your employment? That's called conditions. But this is confidence. So the dark red line is the quarterly, or sort of the trend measure. There's a light line underneath it, which is the sort of monthly numbers, and then there's the long run average. So what I would say to you, business confidence, and I'm talking as of February, so it's only about a week old, is about average. It's a bit weaker than long run average, but it's not falling over. And part of the story is because when you ask them about where your conditions are, they give you a different answer. Now, trying not to scare people. So, this is the answer if you say, how is your trading, how is your profits, and how is your employment? Now, if you're an optimist, you'd say, we're still around long run average. If you're a pessimist, you'd say, it's come down a hell of a lot. And it's still coming down. So that's really important. So we see a big slowing in momentum in the Australian private sector. In terms of some of the The other thing, forward orders, it's sort of saying domestic economy. So domestic is basically blue, and red is our leading indicator based on forward orders. So it's saying the domestic part of the economy has gone from 4% growth rates down to 2%, which is sort of consistent. Now, another way you can look at it is the same sort of thing. I'm just looking at the same graph, except I'm looking at deviations from long-run trend. And what we've now got a situation where forward orders, business conditions and business confidence and capacity utilisation are all now below long-run trend. Not by a lot, but again, the trend is not your friend here. The other thing that I want to show is it varies a hell of a lot according to which sector you are in. Now, we've got a whole pile of different slides on this, but basically the miners are still doing well. General services, so this is basically think health, education, that sort of stuff. It's slowed as well, and I'm sorry for the construction guys, it's slowed a lot, but by far the worst is retail, discretionary retail. And again, that's that story. I don't have enough wages. Therefore, one of the things that is interesting is we go out and we say, okay, the economy's good. And then we go and ask people about how anxious are you? And we did a survey, it's about 4,000 people, picked randomly. The way we do it essentially is we buy private questions in what you would know as news poll. And we say, right, how do you feel? December was the worst reading we've had since 2013. So one of the issues out there is the consumers hears all this good stuff about, the economy's still growing, unemployment's really low. They look at their own balance sheet and they say, oh, I don't like this. And that, I think, is one of the big issues. If we go further on, where is it? It's everywhere, basically. So that's the other issue. It's not as if it's just something went wrong in Western Australia or something else. New South Wales has come down a lot. Let's see if we can find the New South Wales one. So it was the strongest and it's come down to here. For whatever reason, South Australia, West was recovering and sort of gone back down, and Victoria's the best, but it's common. So it's got to be something that's general to the economy. Okay. Now, wages. One of the big issues we've got in wages, and you can see, I think Shorten's out saying that this is a referendum on wages growth, etc. All our models, so we can explain why the actual wages numbers slowed, but all our models say it should be picking up by now, and it's not. So what are the key drivers of wages as we look at them? Basically, it's low productivity. So if you increase wages and you don't change productivity, all you end up doing is making less people employed. But productivity is quite slow in Australia. The miners are not paying ridiculously high numbers anymore. Secondly, and then and wages and prices are low. So if you've not got a lot of productivity and you've also worried about your margins, you're not going to give anybody a pay rise. The other thing that's really important, and probably the number one thing, is the labour market. And the labour market is a lot slacker than you think it is. So if you say, what's the level of unemployment? Well, it's 5%. So that sounds good. However, if I then add on those who have basically given up trying to find a job and are working 10 hours when they should, or they want to work 40, the unemployment rate on that measure is 13. And it's the gap between the real level of unemployment and what we call the underutilisation of labour is growing wider. And until you fix that, it's going to be very difficult to get anybody to give you a pay rise. Now, people can say, oh, this is the change of the economy, the tech, etc. But I'm saying, well, that's reality. And so you can't just legislate for a wage rise in this current environment. And we worry that wages, yes, it might go up a little bit, so you might be running, let's call it 2.5% growth rate in wages, maybe if you're lucky, 2 3/4, but you're not going to get much more. So therefore, I think we're all going to see tax cuts coming. If you want to, so the one thing, because I spend a lot of time in Federal Treasury, I know where some of the sort of bodies are buried. So there's a line that basically says decisions that have been taken but not announced. So there's 9.2 billion of that. And iron ore is higher than what everybody thought. Why? Because Vale, which is one of the big producers from Brazil, got into trouble in terms of their mines. So the iron ore price is about $80. The Treasury was assuming that it was about $50. That's worth about $6 billion per annum. So you're probably going to get that as well as you come up, right? You find out in a few weeks' time. But for me, that is a big issue. This is another way of, and I think this is a really important issue, the consumer. So forget about consumer sentiment. Where are they actually spending? So the way you read this graph is if you're above the zero line, you're spending more of your income on a particular issue. So what's green? Green is utilities, power price, paying off debt. And the one that's also a little bit above, although it's weakened recently, is things you've got to do. So think going to the doctors, I'm getting my kids educated, all that sort of stuff. The one that causes you grief down here is anything else, discretionary retail. So again, 4,000 consumers, that's how they're responding, and that's why they say, I don't like, I'm anxious, and I'm not going to spend anything if I don't have to. Okay. Because there's been this big slowdown in momentum, we've actually started asking what happens or what caused it. And there's a whole pile of things here. We haven't actually published this, but we will soon. Number one thing is I'm worried about consumer demand. Number two thing is I'm worried about margins. A lot of people are saying, oh, it's house prices. House prices, if I can see it, is there. It's not house prices. House prices doesn't help, but it's the balance sheet, or if you like, the budget of the consumer that is the big issue. Big data. So what we're trying to do is we're trying to basically not just look at retail, but we look at any consumption spend. And we can break it up into the whole pile of things. So professional service, think accountants, lawyers, all that sort of stuff. Then you're into services. In terms of retail, you're sort of in the middle. And some of the others down to construction, well, they don't normally spend a lot on construction as a consumer. That is 5 million transactions a day. And the good news or the bad news, depending on how you look at it, we can do that by postcode and we can take it right down to the local street. Now, we're not doing that because we don't want to be Facebook, but it's very useful to get a feel for what's actually happening. So you can put a map up and see which bits of the country and where are you growing and where are you not growing. Okay, inflation. So if you're the central bank, the one that you're looking at is in blue. That's core inflation. So what it is in a very simple term, don't count the top 10% of inflation, don't count the bottom 10% of the low inflation, average the rest. And what you've got there is a rate that's around 1 3/4, and they're trying to target 2.5. And we're not even getting to the 2 until next year. So from an economist's point of view, this is a non-binding constraint. They don't care. So if wages stay low, that's important. The other thing that is really important is the margins, and particularly in retail, online retail is killing the margin. Now, online retail has also slowed a lot over the last 6 months. So we do every online retail, we do it by postcode, we blow it up. And it's slowed from about 18% growth down to about 12. A lot faster than traditional retail, which is sort of doing nothing, but the margin is the issue. Okay, so if you're a central bank, you're seeing a big slowing in momentum, you're seeing no inflation, you're worried that there's no wages growth, but you do know the economy's not about to fall over because of the public sector spending and the LNG exports. Okay, residential property. So, I worked at the OECD. What they tend to do is they say, right, you don't look at the last month's data because it can be bouncy. Don't look at 12 months too, because that can be just telling you what happened 12 months ago. Take the last 6 months and annualise it and see what it looks like. So what it sort of says is that Sydney in blue and Melbourne are falling at about a 15% annualised rate. Perth was recovering, but it's gone down again. So there's this weakness, but it's mainly Sydney, Melbourne, and maybe a touch of Perth as well. Because we're a big bank, we can also do the sort of things, and we look at these things by postcode. So we're in Sydney, so that's Sydney in the middle of last year. So if you're in a postcode and you're red, it means it's going backwards. The more red you are, the worse it is, okay? So that was Sydney in May, Sydney in November. Yeah. Yeah, well, everyone wants to know what's the suburb. So I'm in Brighton. I can tell you Brighton in Melbourne is down 9%. But, so that's this, and we look at that. We look at housing by postcode. So the reason for that, so now I'm going to say what I think is happening. Traditionally, three things matter. Have you overbuilt or underbuilt? Sydney, forget about apartments, houses. If I'm just talking about houses, Sydney is underbuilt. Melbourne is underbuilt. Then what interest rates? Well, interest rates haven't changed. And even though some of the banks have started to increase the rates, we've actually increased the discount even more. So if you've got a loan, you're paying less on interest than, or you should be, than what you were getting a loan 12 months ago. And the final one is unemployment by postcode. And it's about 8% that causes you grief. Now, the best way, in layman's terms, that I can explain this, there are 60 postcodes in Australia that we do not like. I'm sure the Arab Bank doesn't like them either. So that is 1% of Australian postcodes. It explains about 50% of all our bad debts. So 1 explains 50. And everyone always says, oh, you know, is it Mossman, is it this, is it that? No, it's basically the mining towns. But we do look at this by postcode, and that's what we continue to look at. So traditionally, if you ran a traditional model, you'd say house prices should be going up, not down. So I'm going to try and explain now what I think has happened. Number one thing is banks are restricting supply to investor houses. This has got nothing to do with the Royal Commission. This is APRA. APRA's come in and said, we don't like the fact that you've got 40% of your book is investor only. So you can only now have 30% of the flow. And banks are not good at grey. They're really good at red and green. So you say, guys, I want you to slow a bit. So what happened in NAB? We went from 12% growth of investors to 0. So that's number one. And what are the big investor markets? Sydney, Melbourne. Second thing, we're now looking at expenses properly. And so the best way I can sort of explain this, hopefully there's no plumbers in the room, but I'll use a plumber. We can see when you come in your income. That's really easy. Expenses, you know, you come in with a shoebox. And we used to say, oh, guys, just hit the button. An average plumber has these sort of expenses. We don't do that anymore. What we now do is we say, give us the shoebox, we'll go through it, and we'll count it. And I was saying to Joe earlier that one of the issues that out there, and a really good one, so I can say this one because I'm not in Adelaide, so we bank a lot of the private schools in Adelaide, and they're coming to us and they said, oh, we've got a big problem with our churn in our waiting lists. I said, what do you mean? I said, well, everyone's trying to leave. Why are they trying to leave? Because if the bank comes and talks to you, it's $30,000 a year you've signed up for in terms of an expense. So what they're doing is they're finding is people are saying, take me off the waiting list. Now I've got my loan, put me back on the waiting list at the same spot, guys. No, not down the bottom anymore. So I think that is really important. And it takes more time. So, you know, we sort of, on internal data, we're thinking we're roughly doubling the time that it took to get approval. One that I can't sort of quantify, and it's not on the list, but I think it's real, and it's a sort of Royal Commission related one, in the sense that the banks in headquarters were saying, guys, go lend. When you go and talk to the line tends to say, now's not a great time to write a bad loan. And, with the idea of, this is unconscionable lending, etc., I might just be a little bit more careful. And I think that is there, but we can't prove it. Or I'm just saying, when I go and talk to the line, I talk to the line a lot, we see that. And expectations about where prices are going. So I'll use my daughter as the example. Chasing a home loan, well, got a home loan, but chasing to buy a property for 2 years. Now she tells me she's gone overseas for 3 months. I said, what are you doing about your home? And her answer is, well, it'll be cheaper when I get back. So I think there's an element of that. And then finally, the foreigners. The foreigners have been big demanders of apartments in particular. So our best guess in Sydney and Melbourne is around 15% of any sale is to a foreigner. Now, those numbers, 15, 20%, are now down to about 5 or 6. So it's not that they're defaulting, they're not paying up, it's just that they're not demanding it anymore, because I think it's overbuilt. And the one that's particularly overbuilt is Brisbane. So if I just put up some numbers, a lot of numbers, Sydney, Melbourne, we've got about another 5 to 7% fall this year. So we're saying peak to trough is about 15%. Sydney's already 12 and Melbourne's 9. It could well be that Sydney will be a bit further down. But fundamentally, you go back and you say, well, hang on, you've got an unemployment rate below 4%, and we're not changed in terms of undersupply, oversupply or rates. It should be okay. But I would expect another 5% or so falls both in Sydney and Melbourne. The apartment market is doesn't look as big, but this is across, say, Sydney or Melbourne. There are, particularly in CBD areas, where prices are falling 30%. Again, look at by postcode. I put in a whole pile of slides about commercial property. I don't know whether you're particularly interested, so I'm probably going to flip through it. But what we sort of get is we see across our indexes very strong office, reasonably strong industrial, terrible retail. And again, it's a similar sort of story. I flick through these. And so the good news is Sydney in grey is the best, and they think the expectations is going to keep going. So if I'm in Adelaide, it's not so good. So I'm going to flip through a number of slides now, because there's a lot of data. Oh, and this is one. Of the property developers, do you think the banks are going to be easier to get money out of or not? And the answer is they don't expect them to be easier. And I think that's probably a realistic expectation. Okay, so GDP. So we have growth that's reasonably, so the last one, you can see the last couple have been pretty weak. This is through the year. And so through the year, you produce quite a low number, or through the year we've still got 2.5. History has changed and has been weaker than we all thought, so the year average numbers come down a lot. But through the year, around 2.5 is roughly what we think is happening, and then about 2.25 the out year. And in that sort of world, unemployment sort of runs about where it is now. So it doesn't get any better, doesn't get any worse. And maybe towards the end, it starts to drift up a bit. So that's a world, as far as we're concerned, where the RBA is more likely to cut rates than it is to increase rates. And what we're sort of saying is that there has been a big loss of momentum. The public sector is helping to some extent, but eventually you'll get to the stage where infrastructure goes up and then sort of plateaus out at around 25 billion a year in Sydney, Melbourne. And when it plateaus out, that doesn't actually add to growth, because growth is a flow, not a stop. So for us, timing, I don't know. I'm assuming after the election, but if you started to see unemployment go 5.1%, 5.2, 5.3, they pull the pin. We think more likely maybe July, and then maybe November, and possibly something in 2020. So I think it's a sort of a least regret policy. What would be wrong with the Reserve Bank doing something like this, trying to get the economy going a bit better? They're not worried about inflation, they're not worried about wages, they're not worried about people going to take it out and then spend it in houses, okay? So it's sort of a no regrets policy. So I might stop there and take questions. Yeah. Sorry? Short answer is no, not a lot. The problem you've got is, what do you got to lose? What you might do is you might drive the currency down a bit. I don't expect to see the consumer say, oh, wow, 50 basis points, I'll go and spend a lot. But it might help at the margin. And I think once you get down to about 1%, then the Reserve Bank might start thinking about unusual or unconventional monetary policy. And they may, one simple way may be, they just take some money out of the market and throw it into the FX market. And that essentially means you get a bigger bang for your buck.
Alan, Joe Risk, just you mentioned taxes.
Yeah.
It's quite obvious to stimulate the economy, rather than use interest rates, it's got to be fiscal.
Yeah.
Right? So, to what degree do you think the federal government is going to take steps before the next election to generate that confidence about tax? And you've still got issues like the Senate and so forth. Yeah. So we're in a bit of a difficult period here in terms of tax, as we've seen previously.
Yeah, tax is really... look, I have no problem with the idea that you take some money and spend it, as long as you do it in areas that you should do it, rather than for politics. And unfortunately, it's in politics. So I'll use the example when I was in New York last year. I won't say who. A large hedge fund said to me, yeah, that's fine, except look at Melbourne. So when the Libs are in, they build a freeway on the eastern suburbs. Then Labor gets in and they pay $1 billion not to build that, and they build it in the western suburbs. So what you've got to do is something that's sort of better. The idea that we have too much debt is garbage, particularly in the public sector. So the way I can sort of best explain that is I'll give you some numbers. On average, GDP, public sector debt as a percent of GDP around the world is about 90%, okay? Germany's about 80. If you want to get into trouble, Greece is about 180. Japan is 220. Australia is probably going to peak at 18. All right? Now, you can say, oh, the private sector's got a lot of debt. Yeah. But you're talking about public sector. And so I don't mind if you go back and, I much prefer to have a larger public sector debt and an economy that's growing faster. And I think that is really the ultimate issue. Now, you then get complications, what does negative gearing do and all that sort of stuff. And it probably doesn't help. Yeah. Yeah.
Hello, Alan. Ruth Chan from the Commonwealth Bank. I enjoyed your presentation. With the state election looming, where do you see the New South Wales economy going if there's a change of government?
I don't... You guys will know a lot more about the state promises. I did see a lot of ads last night while I was watching the sort of thunderstorms. Generally, if I go back, and they still do this, in Treasury, we used to have a red book and a blue book. Okay, so they still call it that, which is a bit stupid. So on every Sunday morning, I'd have to go in and talk to the politicians and say, based on your policies, this is what the economic outcome was. I don't think I ever saw a red book and a blue book that was fundamentally different. And I don't really see it's going to fundamentally be that different either. Unless you tell me, this is not just New South Wales, this is both sides, and the feds as well. Unless you tell me something is going to be radically changed, then the economy is going to keep going the way it's going. You may be more inclined to spend more money to try and pump it up, but generally, unless you tell me the Reserve Bank is no longer going to set rates and the currency is no longer free floating, I'm going to say it's not going to make a lot of difference. It might make some difference in some sectors. I don't think negative gearing, for example, will help the housing market. Anybody who says they can model it is garbage, because it was only in for 18 months, and you've got to rent. Most rental contracts are 12 months. And in context, basically, house prices were 30% and interest rates were 14%. So how do you compare that to today? You just can't. So it may have some certain specific industry-related data, but generally, I think it's not going to be that different. Yeah. Yeah.
Simon Araj, great presentation, Alan. Thank you very much. There's been some out-of-cycle rate increases amongst the banks and non-banks, and claim is that wholesale funding costs have risen and may continue to rise. I guess the question is, what's the relevance of the cash rate in the context of that? Two, of course, if the cash rate does go down, potentially, are the banks likely to reduce their rates? But also more relevantly, how important is the cash rate indicator? Is the accessibility to credit and the problems in obtaining credit now more of a factor than the actual cost of money?
The simple way to answer that is banks' funding costs are around 60% these days local. Okay. Now, in the old days, i.e. about 5 years ago, before the GFC, or around the GFC, 10 years ago, it was 60% foreign. And so when the cost of raising money at the long end went up, it went up a lot. In Australia, that's less relevant today. Part of the problem has been a technical problem, and that is the cost of banks. If you look at the cash rate effectively, and then look at the 90-day bill, which is what none of us fund cash, we fund 90 days out. The normal gap is about 20 points. It's raised to about 60 points. And that's basically because the 90-day bill rate, or the short-term money market, is basically not working. The reason it's not working, you may remember that ASIC took a lot of the banks and said, you guys are manipulating the rate. So what happens, unexpectedly, well, not unexpectedly, the banks don't want to play in that rate because they'll be up in front of ASIC and saying, you guys are manipulating things again. So that's actually a market failure, and that's important. But I would still say, fundamentally, the cash rate's important, but the other rates are equally important. Well, they're 40%. I don't know if the RBA does cut twice. My guess, and it's a guess, is it would be a very, very brave bank in the current environment who didn't pass it on. Now, if you could somehow figure out, if you're the central bank and you can move that gap between the 90-day and the cash rate back down to 20, that would be incredibly effective. Unfortunately, the RBA really doesn't have the power to do that because of the way the market's being. So I think it will probably get mainly passed on, is sort of the bottom line. Cash rate is still very important, fundamentally. Yep.
Alan, question regarding the property market.
Yep.
You mentioned earlier that Sydney's still undersupplied now, and we're talking about unemployment low as it's been. We've still got economic growth. One thing, my question to you, we still have 100,000 migrants coming to New South Wales every year.
Yep.
What will that do to the property market? And will that, it's all about supply and demand, and eventually, sooner or later, something's going to have to give, and it's going to push the market again. What's your view of that, and when do you think that will happen, if it will happen?
Well, I think you'll still see the population growth continue to grow at the same rate. So what the government has said is they're going to probably bring down the immigration from about 180 to about 160. The good news for you is that it still was only 160 this year anyway. And to the extent that you get faster growth, that just says that that is underpinning the property market. Okay? So the fundamentals will still be good. I've only talked about houses, but the apartment market, by historical standards, is about twice oversupplied relative to what you would think. And if you think that's bad, Brisbane is about 5 times over. But we see that as a lot of that's foreign. So I would basically say, to the extent that you basically have a continuing strong growth in population and it's concentrated in the cities, that just underpins the property market going forward. So if you wanted to be... So I told you, for example, that Sydney and Melbourne are both falling at 15% annualised in the last 6 months, and they're not slowing much. If you go back 4 years, you'll find the Sydney property market's 25% up on what it was, and if in Melbourne it's 35% up. So it's really a very specific cohort that might have problems, and the cohort that will have problems are basically people that borrow or essentially got their loan, let's call it 12 months ago, and now have lost their job. But as a big bank, do we see any stress at all in our residential property book? The answer is no. So we're about 0.9 of 1% bad debts, or 90 days past due. And if I was in America, they would say that is a pristine book. And even by Australian standards, it's a pristine book. And it hasn't got worse recently, a little bit, but 0.7 to 0.9. It's nothing. So we don't see stress. So it's not that the consumer... So when you worry about what might happen, we don't think the consumer's actually going to fall over, because whilst they have a lot of debt, they have a lot of assets. So there's about $2 trillion worth of debt in the private sector, but there's about $12 trillion of assets. So if you look at net debt rather than gross debt, Australia's the second best in the world behind Japan. Okay? Newspapers never tell you that. So we don't think the consumer will fall over. Because we're forever doing stress tests where China falls over, we know the banks are not going to fall over. The problem is, what will the consumer do when they see house prices start to fall? They'll basically do what they're doing now. And that then feeds into the economy. And that's the issue rather than anything else. But yeah, no, back to your question, population keeps going. It means the fundamentals are still good, which means it's not going to be a free fall. Yeah.
Last question. Thank you, Alan. Mark Johnston from LBNco, and also known to much of our friends as the Lebanese Broadband Network Company. Really enjoyed your presentation. What I'm interested in, when you look at your forward loan book, so stuff that you've got actually approved,
yep,
and waiting to start, because a lot of my friends are saying that we're waiting we're just going to wait a while till we put an excavator on site. I'm interested to get some read on how much stock you think is in the apartment market right now. Current course and speed, 20% overbuilt or whatever the number that you're calling. If nothing changes, have we got enough stock for 12 months? Enough stock for 5 years or 5 weeks?
In terms of stock, if you're just talking about apartments, there's a lot of stock. Years worth of stock. We don't see any sign that people, particularly the foreigners, are defaulting. In other words, you read in the newspapers all the time that they got their money out for a deposit. Central authorities have tightened up and they can't get the money out. Now, we think we're only 3.5% of the total apartment market, but it's a $10 billion book, and we're not seeing any sign that people won't be able to settle or haven't settled. So that part is fine. I think where you're going to see the slowdown is not so much in the prices, but in the volume of activity. Yeah, that's right. So think of it as the one we used to use was, think of a python and it swallows the pig. And you can see the pig going through the stomach. It's an activity cycle rather than a big price cycle, I think. And again, it depends what apartment you're talking about. If you're talking about something over 100 square metres and it's got 2 to 3 bedrooms, that's fine. As long as it's not one of 300 in the tower. And in Melbourne, you know, they're 50 square metres or lower and not well built. So if you're in that world, that's a different world. So again, you've got to look at it by postcode. But my general story would be we're seeing quite a slowdown in what we call the pipeline. And so it's an activity effect. And people say, oh, this is bad for construction. My sort of answer is, well, yeah, but you must have had 3 years of probably the best 3 years you've ever had. So you've got to have some spare capacity, presumably. What worries us a little bit is our pipeline in the residential market is not strong. And that's why applications are slowed big time. And, you know, we're in headquarters, we're saying, hey guys, go lead. And that's why the discount is actually going wider than the increase in what the banks are charging. Because they're all saying, oh, we'll discount it then. Get it out there. Okay.
Thank you, Alan. That was quite insightful. I've been to many breakfast functions or luncheons, and I haven't seen too many where someone's giving a presentation and the room's actually quiet, where people are really taking on board what you're saying. So, a very great presentation. Thank you very much. I'm sure a lot of us here, including myself, have taken a lot away from that. Just 1 minute, Alan, sorry. I'd like to call Ed Tancred, the General Manager from LBNCO, to do a vote of thanks and a couple of words about LBNCO.
Well, good morning, everyone. It's certainly a great pleasure for LBNCO to be part of the occasion here this morning, and certainly a big thank you to Alan for your words. LBNCO also very proud to be the event sponsors. We'd like to give a special thanks to obviously the Chairman, Joe Catter, and all the board members from the ALCC, and certainly we look forward to being event sponsors again in the future. Thank you.
Thank you, Ed. I'd like to call the President of the Australian Lebanese Chamber of Commerce, Joe Qatar, to do to present our Chief Economist, Alan Oster, with a gift from the Australian Lebanese Chamber of Commerce.
We really appreciate your time with the banks. These days are so busy and tight with the time there. And thank you for that constructive and informative sort of presentation this morning. And we like just to present you with that beautiful painting. And that painting done by one of the board members of Michael Risk and his Joe Risk brother, and he's with us here today.
Thank you, Joe. We've got a little pot here, and we're going to, so if everyone can throw their cards in here, please do, because in 5 minutes we're going to draw a we're going to draw a card just for some gifts. So please, everyone who hasn't put their card in there, can you please do that? Just another thing too, before we wrap up shortly, I just want to just mention about the Chamber with some of our up-and-coming events. And as I said, you know, for 34 years the Chamber's been working with members locally and abroad, uniting, you know, Lebanon and Australia in our trade businesses that we do. But on the 25th of July, we have our annual luncheon, which is always a big event for us. And on the 12th of September, we've got our sponsors' lunches. And don't forget also our Gala Dinner Awards, which is on the 22nd of November of 2019. But I'd also like to mention is the LED, which is Lebanese Diaspora Conference, which is held in June this year in Lebanon. So it'd be good to have as many members as we can that would like to attend, and I have no doubt it'll be a great event. So everyone, thank you very much for attending this morning. It was a great event, and Alan, again, a big thank you for such an insight on your presentation. And please enjoy the rest of the morning, and feel free to mingle and network with everyone, and meet up with Ed and his team from LB & Co. and have a chat and see what we can do to work in with any of our sponsors, and network together. Thank you again, everyone, and please don't forget to put your cards in.